a lot of the central bank interest in CBDC was spurred on by what was then Facebook's announcement of what was then Libra back in 2019, and the fact that Facebook had access to a user base of 2.3 billion people at the time, and if they were all using it, it could basically remove control over monetary policy and over, their currencies from central banks. And that spurred a lot more central bank investigation into CBDCs.
Welcome to another episode of the Zumo Podcast. My name is Amélie Arras, Marketing Director at Zumo, and today we have a very special guest joining us. Please give a warm welcome to Jannah Patchay, an Executive Director and Policy Lead for the Digital Pound Foundation. Jannah is a renowned expert in the field of financial markets, innovation and regulatory strategy, and she's here to share her insight on a topic that's been making waves in the world of finance, central bank digital currencies, or CBDCs. With her extensive experience in advocating for the introduction of a well-designed digital pound and fostering a competitive ecosystem for new form of digital money in the UK, Jannah is at the forefront of driving transformative change in the financial industry. As a founder of Market Evolution, a consultancy specializing in financial market innovation, she's dedicated herself to building the financial market of the future. Jannah's true passion lies in harnessing frontier technology to create innovative financial services and products that are not only benefiting individual, but also promote social and environmental progress. Today, we'll delve into the world of CBDCs with Jannah as our guide. So we're going to touch on what potential benefits and challenges are associated to CBDCs, how can they shape the future of money and financial inclusion, what role do they play in building a more sustainable and accessible financial system, and these are just some of the few questions that we'll explore during our conversation. So without further ado, let's jump into this fascinating discussion with Jannah on CBDCs and the future of money. Welcome, Jannah.
Thank you, Amélie, and thank you so much for having me on the podcast today.
Well, thank you very much. So, Jannah, I thought we would start with a current affair. This podcast is gaining a lot of media attention, right or wrongfully. Last week, the Treasury Select Committee report was calling for consumer trading unbacked cryptocurrencies to be regulated as gambling. Now, two things I'd like to impact for us. First is, who really are the Treasury Select Committee? What do they have to say about it? And second, what are your thoughts?
So that's a really interesting question. And I think last week's report was, on the one hand, really a storm in the teacup, so to say, in that it really meant very little when you unpack it. On the other hand, it was also treated with a great deal of more significance than it deserved, because it was obviously picked up by the media and heavily reported and things like that. And just to clarify a few of the misnomers around it, I'm going to read from the UK Crypto Asset Business Council's fantastic LinkedIn post on this, which I will share with you afterwards, Amélie, so that you can link to it, where they debunk a few of the kind of myths around this. So first of all, the Treasury Select Committee is in no way affiliated with the government or even with HMT. They are part of the legislature and not the government. So their role is to hold the Treasury to account, but they do not in and of themselves create legislation. So other than being able to send for persons papers and records relevant to their terms of reference, they have no specific powers. The government and HMT are obligated to officially respond to their report, and we can expect that in probably the next couple of months. So key thing there, no official power or role in the legislative or policy development process or anything like that. Secondly, the government and the minister responsible, Andrew Griffith, continues to be supportive of the sector and has reiterated this at every opportunity, even recently stating that the timeline for implementation would be brought forward to within 12 months. And finally, an HMT spokesperson has already come out to say that the government would reject the Treasury Select Committee recommendation, and stated that risks posed by crypto are typical of those that exist in traditional financial services and its financial services regulation rather than gambling regulation, and that has the track record in mitigating them. Crypto offers opportunities, but we're taking an agile approach to robustly regulating the market and addressing the most pressing risks first in a way that promotes innovation. So I think in summary, it's actually provided an opportunity inadvertently to reopen some of the kind of myths about crypto and the risks associated and some of the genuine concerns, and have more of a public debate about them. But it also doesn't really mean anything at all in terms of HMT's progress towards crypto regulation. As you probably well know, the HMT consultation on the future financial regulation of crypto assets just closed, and there was an obvious path that HMT and the FCA were already considering there.
Thank you, Jannah. I guess this is exactly what we're doing the podcast for, is demystifying some of the surrounding crypto, stablecoin, CBDCs and that space, because I feel that there is a lot of media attention, and you can get a lot of media attention by just like talking about topic or having like these very strong opinion, the way that the Treasury Select Committee has done with the publication of that report. But it's just more noise within a space where we actually want to move forward. Now that we've put that on the side, I'd love to ask you, as we demystify a bit, and for those who are listening who are new to crypto, we're going to be talking about something that is quite different to crypto, and these are CBDCs. Could you tell us like what the difference is? What are some of the commonalities between the two?
Yeah, so the topic of central bank digital currencies is absolutely huge, and as you kind of get more into them in more depth, it makes you question everything you know about money and how money works and how the financial system works, and that's what's really fun about it. But I'll start by answering your question about what's the difference between what we think of as cryptocurrencies, so unbacked cryptocurrencies like Bitcoin or Ether or XRP, for example, versus central bank digital currencies. And what is the relationship between them? So I think it's really important in any discussion of central bank digital currencies to acknowledge the legacy that they share with cryptocurrencies, because of course it was the introduction of cryptocurrencies and blockchain and distributed ledger technology that then led to greater exploration of the tokenization of value and assets and money and things like that. And, it's kicked off with stable coins and is now moving on to other forms of money as well. And so there's a direct linear progression from cryptocurrency through to the tokenization of value and what we so far called stable coins, through to central bank digital currency. And the key differences between them are, first of all, the issuer, and secondly, the value that they represent. So on one end, we have your unbacked cryptocurrencies, which technically do not have a centralized issuer as such, and whose value is not pegged to anything. Their value is freely determined on the market, basically, by buyers and sellers. In the kind of middle, we have these tokenized representations of value that are issued by private issuers. So, for example, Tether and USDT, or Circle and USDC, for example, or Circle's EuroC. Those are examples of some of the kind of fiat referenced, as we would say, stable coins that exist. And key there is that the issuer is a private. Then you have central bank digital currencies. And what central bank digital currencies represent is basically a direct claim against or liability against the central bank. So in the same way, effectively, that cash is today, CBDC is a digital native, or you could almost think of it as like a digital native form of cash. So it's publicly accessible, publicly issued money, basically, in a digital native form with which you can do many of the same things as you can from a technical perspective or from a smart contract perspective and things like that. So you can do many of the things functionally as you can with some cryptocurrencies and with stablecoins as well.
Thanks, Jannah. So crypto, no central governance, value, not pegged on anything. Stablecoin, issue of a private firm, pegged to a traditional currency, most likely. And then CBDCs, you said, is it pegged to the traditional currency?
It is. And so I think the interesting thing with CBDCs is that they're not pegged as such. They are actually money in the same way as cash is. And central bank money are today. And it might help if I go into a little bit on the different forms of money that exist today. So today we have publicly issued fiat money and privately issued fiat money. Public money comes in the form of cash, which is the only form of public money to which most people have access, and central bank reserves, to which financial institutions mainly only have access. And the key thing about public money is that it's issued directly by the central bank, and it represents a direct claim on the central bank. So it's in effect kind of counterparty risk-free, because we think of central banks as basically being risk-free. And then we also have commercial bank money at the moment. We have privately issued money, and most of our privately issued money at the moment exists in the form of commercial bank money. And this is where things get really interesting. So if you go to if you have £100 in cash, say, and you go along to your local bank branch and you deposit that into a bank account, you may think, well, now I have £100. That £100 of cash is basically what I own in the bank account, which it's not. You had £100 of cash, which represented a claim against the central bank. You deposited that in the bank, and now you have a £100 claim against the commercial bank. So say it's Barclays, for example. That claim, because of the fractional reserve banking system, meaning the bank lends it out on a leveraged basis effectively, doesn't consist of £100 that the bank is holding. It consists of maybe £10 that the bank is holding, plus a lot of trust and faith and some other reserves of various forms, and a lot of prudential regulation and things like that. But it doesn't represent just £100. And so you have counterparty risk against that bank, basically, because if the bank goes down, the bank may not be able to pay you and everyone else the money that you have in your accounts, which is why we have things like the Financial Services Compensation Scheme. With central bank digital currency or cash or any other form of public money, on the other hand, it's counterparty risk-free. So when you hold that money that you have that direct claim against the central bank. In most countries, the central bank is not going to go down, and that money is not going to go away. So it's a different level of trust, and most people might not think about how that works day to day, or they might not think about what the nature of the money in their bank account actually is. And that's really, as I said, the fascinating thing about the introduction of central bank digital currency. It is public money in the same way that cash is. It's just delivered through a different channel, really. So it's not like a tokenized representation of something. It is money.
There is one thing that you said, and this was the central banks are risk-free, really. You said the claim that we've got on our money, our £100, when we've got £100 in cash, is with the central bank. How does the central bank make it risk-free? And does that differ from one country to another?
That's a really interesting question as well. And I think every country has its own kind of legislative framework that defines the powers of central bank and how money works. I don't know how all of them work exactly, but I think there are some common principles. And one of the common principles, like if you look at a £10 note, I think, it says the bearer of this can, take this to the central bank or something like that. If your £10 note was torn a bit or something, you could take that to the central bank, and the central bank would say, well, this is £10, I will just give you another £10 note. And you can in fact do that at the Bank of England. The bank basically says this is always going to be £10. Now, what that £10 can actually buy you may change over time depending on inflation and things like that, but it always is going to represent £10, and the central bank effectively guarantees that. So there's a whole legislative framework underpinning that, and ensuring that we can trust in that kind of singleness of money, that a pound is always a pound, even when it's commercial bank money sitting in a bank account, it is still a pound. If the bank goes down, you may lose some of it, beyond the Financial Services Compensation Scheme limit, but it still represents a pound, for example. On the other hand, if we look at things like stablecoins that are issued by non-banking institutions, as we've seen, there have been examples of their value fluctuating over time, partly because of the way that they're structured, and partly because of the regulatory regime that surrounds them that doesn't necessarily preserve that kind of singleness of money. So stable coins that are issued by non-banks are not necessarily money in the same way as commercial bank money and central bank money, whether it's cash or CBDC, are right now.
I find it fascinating, to be honest with you, because to me, I see the really as digital cash. It makes all sense. How far are we from having CBDCs in the UK, from what you know from your work, but then in the rest of the world?
So there are a few jurisdictions in which CBDCs are live at the moment. Nigeria has the e-naira, and Cambodia has the Bakong. The Bahamas was the first in the world to go live with the sand dollar. The biggest, which is not really live, but it's such an advanced stage and such a huge scale, is of course China's ECNY, and there are, I think there are a couple of others as well. There are also a number that are in advanced stages of the pilot process. In the UK, I think that the timeline that the Bank of England has mentioned in its latest consultation paper on the digital pound is to have something potentially initially live around 2028. Now, this doesn't necessarily mean that there will be a digital pound in 2028, but it may be that there could be something in pilot form or something like that at that point. I think it's also, when we have this conversation about introducing a digital pound and a CBDC, it's really important to recognize why we might want to have one. And one of the things that people talk about a lot is, well, there's so much innovation going on in the private sector at the moment. There's the stablecoin issuers, commercial banks and e-money issuers are looking at tokenizing deposits and tokenizing e-money. You can put smart contracts around these. You can do all sorts of cool things when it comes to modernizing payment services and things like that. So why do we actually need central bank digital currency? Can't all this just be filled by the private sector? And I think there's a few reasons for that, really. The Bank of England has come out and kind of hit the nail on the head with one key argument, which is the role of public access to public money in maintaining trust in the financial system. So earlier we talked a little bit about how when you deposit your money in a commercial bank, you no longer own £100. You own a claim against the commercial bank, which is actually a different thing. Now, what underpins trust in that is the knowledge that you could go to an ATM or cash machine at any point in time and withdraw that £100 as cash again. And that would be, that would again be that risk-free public money that you have. And as cash use has declined so significantly over the last 20 to 30 years, it's gone from being the main channel in which we transact day to day to something that most of us hardly have at all. The need for continued public access to public money in a format that is accessible and digital native remains really important in maintaining public trust in the financial system. So I think, over the next few years, we'll also expect to see an ongoing decline in cash usage, and therefore that makes the case for introducing a CBDC just from that perspective, like all the cool functional things you can do with it aside, even stronger.
What about older generation? How would they access, if I'm thinking of an old person who is struggling to get to find an ATM at this point to get their cash out, because this is what they all used to. Do you think that we are going to get to a place where the two coexist, the access to cash still exists in conjunction with CBDCs?
So the Bank of England had an access to cash review a few years ago, and it committed, when it completed that review, to continuing to provide cash as long as there was public appetite for it. And the bank, in all of its speeches and things like that, reiterates this point about continuing to provide cash. So I think there will definitely be coexistence. I think we're not seeing, the complete death of cash. As long as there are people who are comfortable using cash, then we will see it continue. Now, we do have, as you said, a very real problem in that cash machines are disappearing, and the access that people have to the cash machine network is becoming more restricted. And also that fewer retailers are actually accepting cash because, of course, there's an overhead to processing and dealing with cash and stuff like that. And these are all challenges that impact, financial inclusion, and digital inclusion plays a role there as well. I don't think that these problems exist independently of the introduction of a CBDC. I think any CBDC that's introduced has to take into account principles of financial inclusion and digital inclusion, and know there will be people who don't want to use it at all and still want access to cash. And the challenges around access to cash remain the same as they are today. So I just want to be very clear that we're not conflating the two in any way.
So what are some other challenges or other criticism of CBDCs? What's your views on them?
As I said earlier, there's the ongoing private sector view that comes from many, not all quarters. And I think there's growing acceptance from, for example, the financial sector about the role played in financial stability by CBDC or by central bank money more generally. But I think that, from a public perspective, there are obviously a lot of public concerns around privacy, for example, around the degree to which there could be government intrusion in people's lives and their spending and control over their spending and things like that introduced by a CBDC, that there could be an intrusive level of surveillance and things like that they might not have full control over their money, that their money might be taken away from them as well. And some of them are true. These are all real concerns. These are all genuine concerns. The way that they can be addressed is through the design of a CBDC. I think that there are some jurisdictions where, CBDCs have been implemented or will be implemented in ways that do not address those concerns. However, the Bank of England's recent consultation goes through some of these concerns in detail and makes it really clear how it's addressing them. So, for example, they've said that a CBDC won't be programmable. So the government won't be able to put in constraints around how your money is spent, or introduce evaporating money that goes away if you don't spend it in a certain time, or things like that. It's designed to be your money and kind of as dumb and close to cash as possible. The other around privacy is that neither the central bank nor the government will have any access to user data. They won't have any user data or be able to see it or anything like that. Only the payment interface providers, the wallet providers, would have access to that data and to transaction data at that level, in the way that commercial banks have access to your data and your bank account data and stuff like that today. And that's meant to address those privacy concerns. In terms of other concerns, one thing that really interests me always is, CBDC was kind of born out of, or not born out of it. A lot of the central bank interest in CBDC was spurred on by what was then Facebook's announcement of what was then Libra back in 2019. And the fact that Facebook had access to a group of, a user base of 2.3 billion people at the time. And if they were all using it, it could basically remove control over monetary policy and over, their currencies from central banks. And that spurred a lot more central bank investigation into CBDCs. And private companies like Facebook, their entire incentive and motive in issuing, payments mechanisms like that lies around the potential to collect and monetize the data associated with transactions. And so I actually think there's probably more concern around some potential private sector solutions than there would be around a well-designed CBDC like the one that's proposed by the Bank of England.
Thank you, Jannah. It's fascinating to hear the challenges also around CBDCs and how they can be addressed. So yes, if I hear it right, if we work and design CBDCs in a certain way, then we are able to achieve innovation, which is what they are, why we would have a CBDCs, whilst also satisfying some of the privacy concern that comes around it. To finish up on a question, what excites you the most about CBDCs?
Oh, that's a great question, because I think it's, I've been working on CBDCs and stablecoins and new forms of digital money for several years now. And sometimes I feel like I have to go back to the why of it all. And for me, the why of it all had nothing to do with payments. My background is in capital markets and financial markets. And my real interest in getting into the digital asset space was the potential for digital assets to kind of represent the next evolution of financial markets, and to introduce new possibilities for designing digital native financial instruments that could really embed ESG measures and kind of embed sustainability metrics in the financial system and stuff like that. So when I take a step back and I look to the future, I'm excited about the introduction of CBDCs, ultimately because they're going to enable this better, more sustainable, and more kind of socially and environmentally focused financial system.
Thank you, Jannah. And this could be a podcast on its own regarding sustainability and the financial system. To wrap up, what are the 3 books that you would recommend to people that you like or that you recommend?
Oh, wow. Okay. So I think 3 books that have influenced me and my life a lot. And they may not be the most important, actually, ever in the world. So I'm reading A Wrinkle in Time at the moment to my 7.5-year-old son. And it's reminding me how much I love that book. And actually, I have a tattoo that I had forgotten was actually inspired by that book. But I think it was one of the books I first read when I was about 7 years old, and it's instilled in me a passion for science and technology that's kind of lasted my whole life through. The second is a book by an astronomer called Carl Sagan. He and I actually share a birthday. And strangely enough, I also have Carl Sagan-inspired tattoos as well, called The Demon Haunted World, which is basically about, again, the importance of science and rationality in our thinking and in the way we approach the world and things like that. And then the final is not just one book. I would say that the collective works of P.J. O'Rourke, although I don't always agree with his politics, are both hugely entertaining and have massively impacted the way I see the world and my understanding of economics and people's behavior and things like that. So some of them might be a bit dated, but I'd hugely recommend them as well.
Oh, thank you. I absolutely love these recommendations. It's my favorite question of the podcast, discovering what next will I be reading. So Jannah, thank you so much for joining us today on the podcast. If people want to find out more about you.
My LinkedIn profile, Jannah Patchay, I'm the only one. And also please do have a look at the Digital Pound Foundation website for more about our work.
Thank you so much, Jannah.
Thanks, Amélie. It was great being on the podcast today.